All right. See, are we rolling?
Rolling.
Okay, let's roll then. We're going to be talking about the merge, the markets, the mortgages, the mess. That's, of course, Social Security I'm talking about. All right, let's get it going. All right, and we are back. 2-week hiatus. It's been too long, Jeff. I just feel like we need to increase the frequency here.
I agree.
Yeah, there's just so much that happens in 2 weeks. It's good to see you, though.
Yeah, you too.
I mean, I see you all the time, but it's good to see you across from this table with a microphone in front of your face, getting ready to talk about the merge, the markets, the mortgages, the mess I like to call Social Security. But we got a lot to cover, so let's get into it. I'd like to try to keep it under 30 minutes for our viewers there because they got lots to do. But listeners, but yeah, let's talk about the merge. And in the merge, of course, what I'm talking about is the Ethereum blockchain merge from proof of work to proof of stake concept for validating transactions. And today's merge day. So those in the Web3 blockchain and specifically Ethereum communities are celebrating today, right? It's a kind of a big day that's been long since anticipated. And there's a lot of confusion around it, I think. So I just wanted to spend a minute, top of the show, kind of talking to people about what this means. Because I think those who invest in cryptocurrencies kind of had this expectation, like this is gonna send, prices soaring higher. Of course, the opposite happened, which many of us probably theorized would happen, kind of a sell the news type of scenario. But that's not to say that this isn't very significant and important for the long term when it comes to Web3 blockchain digital currency. So wanted to spend a minute. But so just the proof of work concept involves mining, and it's very energy taxing, right? It requires a lot of energy consumption, which I'm sure you've read about when you read about blockchain or cryptocurrencies and so forth, right?
Yeah. Well, I read an article that was talking about proof of work and data mining using up, it was a couple of years ago, using up the world data mining energy usage was more than the entire country of Switzerland used or produced electricity or used electricity over a year.
Yeah.
It kind of blew me away.
Yeah, exactly. So it's an issue, right? If you're going to have that kind of thing going forward of expanding, emerging technology or theme that's supposed to reshape the world and how we do things. So that's why this was so significant. Moving to this proof of stake concept on the blockchain for validating transactions is said to reduce energy consumption by 99.9%.
It's amazing.
Yeah. I mean, it's 99.95%. In fact, they say that the move in this merge would decrease worldwide electricity usage by 1/5%. Worldwide, just on the Ethereum blockchain, just doing that merge.
It's a staggering amount for
anything to move worldwide consumption on anything like that. I mean, it's astounding, right? So again, a lot of people are thinking like, oh, this means that, once this happens, my tokens are going to be worth more. Essentially, nothing changes for the users. I mean, the users that use the technology on the Ethereum blockchain, your cryptocurrency, the end users, there's nothing really different, right? But for the planet, for the environment, and for the future of blockchain, right? You can say that in Web3 that this has very, very dramatic outcomes either way, whether it's successful or not. And there is some other things, right? I mean, chips cost a lot of money.
Yeah.
Okay. GPUs, right? If you're a gamer out there, you were pretty ticked off the last couple years with how much these units started to cost. And a lot of that was driven from the increased cost in mining that we needed, the demand in mining. So this is going to, kind of permeate to some other parts of the economy where you might see some softening on some of the prices of some of these things. But the most intriguing part about this, in my opinion, is that when we talk about this new world, and you and I have talked about this morning, right? And not in relation to this, but theorizing about where this new world can go, not just from a technology standpoint, But here we are. All of this happened with a major company, a major technology, a major shift, all without a board of directors, a CEO, a vice president huddle, department head, shareholder vote. It was done in the Ethereum communities, right? And as a community of movement that made this happen, and it was successful. And I think that is something to really pay attention to. So I think that's something to pay attention to.
What are the implications? Like what blockchain do you think about? When I think about blockchain, I think the things that are really interesting would be, take your investments, for example. When we buy and sell a mutual fund or a stock or an ETF, it has to go to a clearing firm.
Right.
And it takes a couple days to settle.
Yeah.
And sometimes if you want to sell something because you got to send money out for a distribution, it takes 2-3 days. So you got to do it in anticipation. With blockchain, that'll be done in seconds.
Right.
You've exchanged on the blockchain your ETF for cash, and it's there right away.
I think it's less than seconds.
But it's instant.
Instant.
Say, I need cash today. You can do it in seconds. There it is. It's available.
Yeah.
And wouldn't it be the same in mortgages, housing? You've already kind of pre-approved. There's no 30-day title search. You just you go in. You're pre-approved. Blockchain, bought the house. Here's the key. I'm in the house in 30 seconds.
Yeah, those are the NFTs, right? That you can issue. Right?
Yeah.
So an approval on a mortgage, right?
It's very disruptive, and it's interesting. It's going to speed up the way we do things,
which should be good things, right?
I would think so.
I mean, it's bad for parts of the economy whenever you have emerging technologies, because it just takes out entire industries because we don't need them anymore. Right. I mean, I was in the airport not too long ago, and the guy had his coffee and his newspaper, and it just looks so funny. Just fanning out the newspaper and folding it to get to the article that you need. I mean, that's just how everybody lived. I remember that. You remember that. You did it. And here it is when you see it. It's like, whoa. Look at what that guy's doing still. It's amazing, So anyway, that's what happens when these technologies emerge. This is an emerging technology. Be very careful racing out and buying cryptocurrency tokens. Okay, so you can of course play a little bit there, but the it's not written about what's going to be successful. But this technology is definitely something that you have your eyes on, that we have our eyes on, and it's going to be here for years and decades to come. It's just in its infancy, and I think that's my opinion. And I think that this move in the merge is very good news for believers of Web3 and this technology. So anyway, I just want to spend a moment on that. Thanks. The merge done. The markets, what's gone on? So for 2 weeks, June was ugly, right? And we just had a reprieve, a little bit in the summer. So, but over the last 2 weeks, we ran it up and then came back down. We're about where we were 2 weeks ago, but what's happened?
Yeah, it was a heck of a move, wasn't it? So market ran up last week, I guess, in anticipation of some big data this week, which was obviously CPI, right? Inflation data. And I think it was the anticipation that inflation data would be lower. Gas prices were lower. Some food and energy, some food costs were lower. Retail, a little bit lower. The idea that we would have softer inflation, and therefore what would happen? The Fed would be less hawkish and wouldn't be as aggressive raising rates. And what would happen if they decided to kind of change the trajectory of their rate rises? That would be good for equity markets.
Yeah.
Well, inflation it's moderated. I think we can agree it's probably peaked. We hit 9.1%.
But what happened?
It came in at like 8.3, and I think we were expecting 8.1. And then you had some Fed officials coming out and saying, hey, we need more than a couple months of good inflation data or better inflation data to change our path. So it's almost like the traders ran the market up. The data didn't support the trade, and it reversed itself. And Tuesday, as we know, was ugly. We had a 4 or 5% down day, and it kind of gave it all back, but kind of net neutral for that period. But I think we just realized that, and you and I talk about it, I don't know what's shocking about it.
Right.
I mean, they've told us and told us and told us since January, hey guys, inflation's high. We don't care about anything else right now other than inflation. We're going to keep raising rates until we get convincing data that inflation is coming down, but everybody's freaking out like it's the end of the world.
And you talk about a terminal rate. I know you've quoted that in some of your writings and on the podcast, I believe. And again, just what's the terminal rate? What is that?
It's basically the end of the rate hiking cycle.
Okay, so we're at
2.25 to 2.5. It's a range, but let's just call it 2.5.
Just call it 2.5. And where's the terminal?
It's closer to 4.
Okay, so let's call it, we have 1.5% to go. If we're raising 75 basis points a time, there's 2 more rate hikes, right, to get to that. And that's we hope number.
Right.
Right? It's not draw a line in the sand, but we know we're kind of targeting that.
Right. So we're going to end up.
So what's confusing about this?
Nothing.
Right.
I don't understand what is confusing about it.
The market's confusing. The market's so confusing in the short run. And I mean, that's why I just, I'm thankful for our listeners and viewers that they come here for our perspective because, and I hope you gain solace in listening to us for this brief period because the markets are so darn confusing in the short term. I mean, for the Fed to come out and say, we have inflation and we're going to continue raising rates. Yeah, we got it. And then for the market to sell off 4%, 5%. I mean, it's just such a big move. And it's just such an overreaction. And it's short-term traders trying to catch the Fed pivot, right? And it's just better to leave that alone. And this is why we don't day trade and look at it. I mean, some do, and God bless them, but as investors, we don't. We're making long-term investment decisions, and these things really don't matter to us in the short run, that they are saying that we have inflation as 8.25 versus 8.1 consensus.
Right.
Breathe. It's not a perfect math science number anyway.
Correct.
I mean, it's a basket of goods and from a basket of shops and and
it gets revised.
It gets revised
in the rearview mirror, and then they change it.
But the dad's not turning on the allowance anytime soon, so the traders got a little sad and started selling. But yeah,
and it's probably something in 2 years from now we won't even remember this conversation.
For 2 months. 2 months.
Yeah.
So yeah, that terminal rate, that's this is their path to keep a soft landing. So still, look, we're not saying that there's not headwinds out there, and we're not saying that this is calm waters, but when you hear this news and you see these gyrating markets, step away. There's nothing to do. Okay, this is just an overreaction. The raising rates you mentioned, though, it's a worry. It could definitely cause a recession at some point, right?
And that's kind of the position I think everybody's in right now is that you turn on CNBC or you just read anything, and what's the big issue? It's like inflation is running hot, interest rates are going up. Bad economic data says the economy might be slowing down, and therefore the Fed's going to reduce rates, and everybody thinks, well, reduce rates would be good for equities and it's going to take off. And then good economic data comes out and people freak out that the rates are going to go up. But like you said, it's just noise right now, but it's something that you have to just turn off and focus on the long term. And, we'll bring inflation down, interest rates will go up, and you're actually earning cash on your money, or return is on your money right now. You're getting an interest rate on your cash. You're getting better bond yields. It's not the end of the world.
Yeah, that's interesting. When the key to happiness, Jeff?
There's only one key.
Yeah, it's really one key. There's an equation. A happiness equation. And you take your gratitude and you divide it by your expectations. And that will equal your happiness score, right? And if you want to be happy, you can do 2 things. You can increase your gratitude, or you can decrease your expectations. If you want to be sad, don't be grateful and expect everything from the world, because you will be so disappointed, right?
Yeah.
I mean, it is just something that is a key to life. If you ever feel sad, just ask yourself, do I need more gratitude? The answer is yes, always, in this world, this day and age. Do I have too many expectations? Likely yes. But it's those 2 things that cause sadness and nothing else. Even if your loved one dies, you're expecting them not to. It's okay to be sad, but it's only because your expectations aren't met, right?
Right.
Anyway, I'll hop off redirect my soapbox. I won't hop off. But when you think about the markets, the good news is is you can find, if you're sad about the markets, if you're fearful about the markets, you can shift your gaze, right? There's certainly a lot of gratitude that we should have at this point, right? For where we are today and what's been afforded to us by the rising tide that we've had in real estate and in the market and in our net worth and our portfolios and what we've enjoyed. There's certainly a lot to be grateful for. My expectations, though, should be in line with what's happening, right? And I guess my point on this is like, I can look to the future and I can pick my gaze, like pick how far out I'm looking, and my emotions really change, right? So I could look over the next 30 days and whew, man, I mean, it's just, I can't see. It's actually like not visible, right?
Right.
You can't see. It's like white it out, right? And so if I look a little bit further, you're like, okay, is there a recession down there? You know? So that's kind of what you were just talking about. You know, it's like, do we have the markets run up and then like, do we lower interest rates to save them? Or does the market come down, then we lower interest rates and then the market goes up? But either way, right, we're talking about what the order of events are for the market to continue going up, which it does permanently.
Right.
And so if you're looking at this thing, you're like, well, it could go down. Great. Look a little bit beyond that. Just a little bit beyond that. And what happens? Oh, it's going up. Shift your gaze.
Right.
You know, because that should be your expectation. Now, you want to try to time this next drawdown and go up. Do you think that it's not going up permanently? Have you understood or looked at a long-term chart of the market at all in your life or on the show? Okay, so it goes up permanently. Yes, yes, yes. Good. So what does it matter, right? Can we just look a little bit further on? So anyway, I think as we're talking about all this, it's really important to put that in perspective of what can we do in the long run, short run. This doesn't mean put your head in the sand. This doesn't mean your asset allocation doesn't matter, because you have to be able to make it to that point in the future.
Yeah. And
that's where financial planning and asset allocation come in. But if you've done the math and you have the right plan, you have the time, turn off the news and go for a walk and get some gratitude.
Right. It's well said.
You're alive.
And don't bet on the end of the world.
Yeah. Don't bet on the end of the world. That's a good one. All right. Can we move on to?
Let's talk mortgages.
Yeah. So mortgages hit 6%, over 6% for the first time since 2008. Don't you just love that? Yeah. I got a pit in my stomach every time I hear, oh, first time since 2007, first time since 2008. Like, stop saying that.
Right.
Because we lived what happened after that. But that's always not to say that, you know, we don't relive that same thing twice. But yeah, we don't like hearing it. So 6% mortgages breached for the first time since 2008. So that's astounding.
That's a far cry from 2.75 at the beginning of the year. That's a sudden move.
I take it back on astounding, though. Is it astounding?
6% isn't astounding.
Yeah.
Relative, if you go back and look at mortgage rates over time, we talk about it, 18% mortgage rates in the 80s.
Yeah.
But the move from 2.75 to 6 and the cost of carrying a mortgage being 40% higher, that's a big move, and that's stalled housing.
Yeah, in the mid 2000s, they were 6%. I mean, that's really what it was before the Great Recession.
Yep.
And there was no problem. Housing was in a boom at 6% mortgages, right?
Yeah, it was.
So didn't end well, but it was quite a boom.
But
they're also levered 90%. It was a little bit different.
Well, there you go. There's a lot more. There's a lot less leverage in the system, and there's a lot of people who have mortgages well below 6%. Right? They're locked in.
I think what this does to me when I read this, why it's so, what I say, astounding, is that it has made housing affordability the worst it's been in almost 40 years. And because even though you have these higher mortgage rates, like, you still haven't seen, although the real estate market is softening, you've seen that happen over the last few months, certainly. Folks in real estate have seen it. Real estate investors have seen it. And we just know that it happens, and you can just tell.
Right.
Time on the market, price drops, it's happening. So you're just seeing that, maybe we've reached that apex, but you still have pretty tight inventories, still have pretty strong demand. and you have fear, or not fear, you have greed and FOMO going on right now in the market, right? And it's kind of like these irrational tops and bottoms. In any market, you can kind of look at this fear and greed, FOMO or FOLO, right? And so this FOMO of, people buying homes, is like, while they can, like there's just nothing out there. I need to get something, right? So you have that fear of missing out and they got to get in. And then you have this greed, a lot of greed by homeowners,
Right.
that saw Zillow said their house was worth $2 million, and the mortgage, or their real estate broker's like, well, it's probably 1.85. The market softened and probably wasn't worth 2 million. They're like, nah, we're sticking at 2. We'll go down to 1.95. You're gonna have that.
Right.
So these houses sit because that greed. They're gonna say, no, I'm holding at 1.95. They're gonna end up selling for 1.6. And you just see that thing happen, and that happens in real estate, happens in stocks, like any markets, right? You see that greed,
and you have that bid ask between what buyers are willing to pay because they see what the new value is,
right?
Versus anchored to this older value by the seller, and it's going to be this little
that's when
game of cat and mouse until they kind of come. At some point, somebody's got to sell or somebody's got to buy.
But don't you think that kind of signified a top when there wasn't a gap? In fact, it was the inverse. When homeowners were saying, "I want 2 million," and they're like, "I'll give you 2.4
and no inspection.
I'll give you 2.2. I'll give you 2.6. It was a negative spread.
Yeah.
Negative bid-ask spread. I would say that's signs of a irrational top market.
It is. And I think one of the reasons that house prices haven't really softened in terms of pricing is because there really haven't been many transactions because of that.
Yeah.
They're still stuck to those numbers. The buyers are being more realistic. And so
the game's totally changed. I mean, a 6% mortgage versus a 3% mortgage. Come on, what are we talking about? Of course,
it's 40% more a month.
Yeah, it's going to be a different number. So, anyway, greed is typically not a good time to be buying. So, there's some fear of brewing, just maybe, and that's a good time for buyers, right? Yeah. Sell the greed, buy the fear. But I saw a really interesting analysis of the affordability, essentially to bring back housing affordability to like pre-pandemic prices, or 2 years ago, I guess. One of these needs to happen. Either we need to have a 40% rise in household incomes. Okay. So everybody needs to make 40% more money. And then the affordability is going to be like, okay.
Well, that's not happening.
That's not happening. Okay. All right. We can have a 3% cut to mortgage rates.
So a 50% cut from 6 to 3.
Yeah.
Right.
So interest rates decreasing.
Yeah. That's not happening.
Oh, well, you're not going to like the third one, Jeff. Can you guess what the third one is?
Humor me. What is it?
A 30% pullback in the market.
Yeah.
Right? So, look, it's probably a combo, but, who's to know? But if incomes go down, call that a 40% pullback, right?
If it's going to be a combo, it's not going to include the first one. You're not going to get a 40% rise in incomes.
Yeah.
It's going to be a combination of rates coming down a little bit.
Yeah.
And prices coming down.
Yeah. Yeah.
But that also has implications for inflation, unfortunately. Tying back to what the Fed is trying to do, bring down inflation.
Right.
Slowing housing by driving rates up. Mortgage rates go up. Housing demand goes down. Home builders build less. We're already building too few. That pushes up rents.
Yeah.
With our rents, we talked about it. It's a big part of the inflation basket.
Number, yeah.
So that pushes rents higher, and so that keeps inflation higher and longer. So that trajectory from 8% inflation down to their mandate of 2%,
Yeah.
Even speaking to some of the biggest bond fund managers in the world, talking to them the other day, it's like they were thinking we're going to get to inflation really quickly, and now they're like, oh, it's going to be a lot slower. So think about that line being steep from 8 down to 2, and they're like, no. It's going to go like this now. Like maybe at the end of the year, we're down to 4 or 5.
Yeah.
And so inflation is going to be a little bit longer because of things like that. So here you have the Fed trying to get rid of inflation, and they're slowing things down, and they're actually driving inflation up.
I'm just so sad about all those people that didn't go to our class or take our advice and paid off their mortgages. Can you imagine sitting there with a 2% mortgage, 2.25 in this market, and like where that's headed, and like what you could rent out a house for right now, and like you had a 2.25. Oh my gosh, we should have all been asking for assumable clauses on these mortgages too, right? Yeah. I mean, imagine selling a house and they can assume your 2% mortgage and what you can sell it for.
Well, do you know that the US is one of the few countries where you can amortize over 20, 30 years, but you can't lock in 30-year mortgage in Canada or Australia. You only lock it in for 5 years. Here you get to lock in something at a low rate like that. And think about it, you're paying 3% and inflation's 8%.
Yeah.
You're getting paid to take that house. It's costing you less and less every month to pay that back, and people still want to pay down their mortgage.
Yeah.
Doesn't make any sense.
Well, I mean, this is a great point. If you have a 6% mortgage and you're paying down principal, you're guaranteeing a 6% rate of return. If you have a 2% mortgage, you're paying down principal, you're guaranteeing a 2% rate of return. Same action, very different outcomes. Important to understand the math.
Yep. It's just math.
It's just math. All right. Hey, we got maybe around 5 minutes, and all this inflation, right? What does that mean for our retirees collecting Social Security benefits or about to collect Social Security benefits? Because any of your future benefits are going to be cost of living adjusted. I mean, we're going to see the biggest boom we've seen in I don't know how long, probably 50 years on Social Security this coming year, I would imagine.
Wasn't it? I think they already put it out. It's like over 8%.
So 8.7%, let's say, right?
Yeah.
So they got 8.7% is what you're going to get in January. I mean, if you're collecting $3,100 a month in Social Security, that's $270 a month extra. It's a big chunk of change.
Yeah.
I mean, that's over $3,000 a year that you're going to get. If I think about offsetting some of this increase in gas prices, that's going to be pretty nice.
Yeah.
And the good news is once you get those inflation bumps, they don't go back, right? I mean, we kind of get them,
yeah.
Right? So, if you got your Tesla and you get your $270, you may be doing okay.
Yeah.
So I think that's going to be helpful. There's a couple of things about Social Security, though, that you got to also just know. So, again, we teach in our course, which are enrolling now. We're in our course, we talk about Social Security and the importance of and about math and the time value of money and why you don't want to pay off a mortgage and why you don't want to wait to collect Social Security. And those are two things people come into our course all the time. Like, I'm paying off my mortgage. I'm waiting until age 70 to claim Social Security.
Well, the Social Security one is the one that I always get.
Yeah.
And some people are starting to understand the mortgage equation.
Yeah.
Especially when you show it to them. But somewhere, Social Security, that just...
Well, all the literature says to defer, right?
Right.
Of course, right? Bunch of spreadsheets that, people create and do the math and they say, oh, here's what the number is. But, there's a little bit more to the equation. They miss some of these things. But this is bad news for Social Security, especially those that are waiting, okay? First of all, it's bad news for anybody who's in a low-income situation because what's happened is a lot more people are going to just pay taxes on their Social Security, and they're going to give half of this COLA back to the government.
Mm-hmm.
It's not lost on the government why they wrote those rules.
Right.
Okay. So they put a tax in Social Security back in 1984. And so if you are a low income household, you didn't have to pay taxes on Social Security. If you were in a moderate household, you had to pay 50% of your Social Security were taxable. If you're in a higher income household, you had to pay 85% of your Social Security was taxable.
Right.
Well, those numbers haven't been adjusted since 1984. They didn't inflation adjust those numbers because they would inflate Social Security, but they would take it back in taxes too.
Right.
Right. And so that's how they kind of made that work. So single, you don't pay taxes if your modified adjusted gross income is below $25,000, $34,000 if you're married filing jointly, right? Above that, 50% up to like $32,000 single and $44,000 joint. Above $32,000 single, $44,000 joint, 85% of your benefits are taxable. So you add on this, a lot of people are going to kind of get pushed up in the other bracket. To put that in perspective, the numbers today should be about 75,000 and 95,000 if that was inflation adjusted.
So then what about the importance of a Roth versus a tax deferred IRA and how that works in?
Well, yes. And of course we have all that too, right? I mean, that's a big part of our course. And like, if you can actually have a pretty considerable income in retirement and stay below those numbers, right? And so not be impacted by this.
Right.
Because the modified adjusted gross income equation only includes half of your Social Security payments. But anyway, for a lot of folks that only have Social Security and maybe a little bit else, but they might pay a little bit more, we'll see. But the big implications for all retirees, well, mostly the ones listening to this podcast, is this just brings the ever-present phenomenon that Social Security, or fact that Social Security is running out of money. And in 11 years, they are going to be out of money.
When did the changes happen? Is it 32 or 34?
So there's no changes. There's just Social Security, and they collect taxes.
Right.
And they pay out benefits, and then they use the reserves in the trust to, pay out the difference.
Right.
And then those reserves are exhausted in 2034. And at that point, there'll be a 22% reduction in Social Security benefits across the board.
Yeah.
So we had a 22% reduction in Social Security. So to put that in perspective, on that same 3,100, if you're getting 3,100 in Social Security, you're going to see about a $700 decrease, $685 out. That's going to move the needle.
Yeah.
All right. Now, this is why inflation actually matters so much, is because that was the 2021 study. Okay. So now when you start ratcheting up benefits by 8.7%, like in perpetuity, like it's going to exhaust a lot sooner. You're going to have to pay out an extra $270 of benefits to that person. Maybe you're only factoring in a 2.8% average, 2.4% average COLA that's been going on since they've done this. So
that reserve runs out much faster than 2034.
Yeah. Well, it's going to. That's just math.
Yeah.
I'm going to pay out more. I have the reserves. It's like if you have a retiree and they're like, I need to increase my distribution. I'm like, you're going to run out of money sooner. Right? That's essentially what Social Security is they are a retiree that's spending money and saying, I am going to be out of money in 11 years. And then what? So what has to happen? Right? An act of Congress.
Right.
Like here, can we show also this slide? You have it in front of you. Sierra's going to put it up for our viewers. Listeners, what I'm looking at is this is the interest rate that the government pays to borrow money for 30 years. It's called a 30-year treasury. So back in the 70s and 80s, we paid 8 to 15% to anybody who would lend us money.
Yeah.
Who lent us money? Social Security. The 12.4% Social Security tax, 6.2 to employers, 6.2 to employees, is a tax. And it went into a basket called the Social Security Administration Trust Fund, which had a mandate that it had to be invested in government-bearing interest securities. It's in the law. What is that? It's loans to the federal government. So it's not like there's like a Fort Knox situation here with a pile of cash. It's just IOUs that were 30 years ago accruing 8, 10, 12, 14%. Right? Look at this number. Look at what is maturing from the social. These bonds are in the Social Security Administration Trust because this is 30 years ago.
Yeah. These
are all maturing right now. So look at what's maturing. So as these bonds, as the 30 years up, remember how a bond works. If I borrow $1 million for 30 years at 10%, I make my 10% every single year, and then in 30 years I get my $1 million back.
And not a penny more.
And so now they get that $1 million back, but instead of getting 10%, they're going to reinvest it today at 3.
I'm starting to see the problem.
You get it, right? And so, hey, rising rates over there, maybe some good news for Social Security, but the rising inflation has way outpaced the rising rates, and it did not before. It was the opposite. This is why they built up such a surplus.
Yeah.
Do you know the last time we had a deficit in Social Security?
I do not.
1983. Do you remember what I just said? It happened in 1984. They began taxing Social Security.
Yeah.
So there will be some changes. They won't be to your benefit.
No.
Social Security will be less beneficial for you in the future, and there is no way around that. And it might not even exist for you in the future. Okay? Now, Congress, they're going to start addressing this problem when? The Social Security Administration Trust Fund runs out of money in 11 years. Do you know the average tenure of a congressperson?
I would think it's long, isn't it?
11 years for the Senate, 9 years for the House. So representatives here say they have a 10-year average lifespan.
Right.
I think that's the mean. So, we got some old dogs in there that have been around that are probably, getting these numbers up. It might be on average shorter, but 11 years isn't an eternity to one of our representatives in the House and Senate.
Right.
And so I don't expect any movement on this for the next 5 to 6 years, and then it being very hot. So we'll see who's in office. We'll see where the country is. But the sad truth is more than 50% of retirees today rely on Social Security as their primary source of income in retirement. Not their supplemental, their primary. And if you think you can cut their benefits by 22%, you're sadly mistaken. That other 50%, though, you're a target. So again, do the math, get your plan, get it early. Here's the 30-year chart, man. I mean, look at it. It doesn't look good. You know what the yield was on Social Security Trust? I looked it up. I know you don't. I'm just asking these, rhetorical questions.
This is a rhetorical one because I don't have an answer.
Like, these obscure facts you Google right before the podcast. Did I know those? No, Dustin, I didn't. The yield on the Social Security Trust last year, 2.4%. That the total portfolio, that's how much they make, right? So that's versus what they pay out. So you get the problem. We're in spend down. That's it. Anyway, we call that the mess. So the merge, the market, the mortgages, the mess. I hope we packed in a lot for you. We do have classes enrolling at retirement101.org, presidiocm.com. You can find us, schedule time, have a review, and we are here with you as always and back in the studio in a couple weeks to talk about gosh knows what goes on between now and then. But anyway, subscribe, follow, and we really appreciate you listening and tuning in. All right, we'll see you next time.
See ya.